Hi everyone, welcome to this webinar. As you'll have seen from all my emails, I put a lot of time and effort into this webinar. So welcome one and all, make yourselves comfortable. We are going to start straight away. I'm going to share a screen with you immediately. Hopefully I've got the right screen. Yes, you should be able to see and hear me as well. Please let me know you can see and hear me. Put it into the chat box so I can tell that you can indeed see and hear me. Hi, Themis. Hello, my old friend. And also what I want you to do is answer the polls as we go through them. But like I said, I want to make sure you can all see and hear me first and foremost. And then we'll kick off. Tell me where you're from. All right. And that's really important as well. So that we can get to know each other. Looks like you can now. It's all coming through now. There's a slight delay between when I ask the question in real time and when you see things. Now, the big question at the moment, which are the great stock investments? The US markets are at all-time highs. Have you missed the boat or should you stay out of the water because it's going to get choppier? What do we do? How do we get a return? So thank you. Welcome, John, Jeffrey, Josephine, and everyone else. Quite a lot of people, especially from Birmingham as well. All right, so there's the question I'm going to ask. Now, I recently asked on my private Telegram channel, which I'll tell you about a little bit later, I asked a bunch of people, how much reward risk do you want? And I'm going to answer all of these questions in this webinar. Almost half of you said that you want higher reward in safer stocks and leveraged return appeals, but a little bit of leverage, obviously, but in safer stocks. And then the other bunch of you said Microsoft. So yeah, we're going to mix it up. We're going to look at adding a bit of zip, but to safer things. Okay. So I'm going to answer all of these questions in this webinar. As you're all making yourselves comfortable, grab a drink. One of the things I want to say, I'm going to start doing this at the start of all my webinars. Look, investing is one of the most useless professions in the world. The profession I'm in, it's one of the most useless in the world. It is the hardest, easy money you will ever make, and you're going to have to find your fulfillment elsewhere. I am co-chairman of the Lombard Trust, which cares for widows and orphans around the world. My other chairman is Lord Billamoria. We're fortunate enough to have some good people on there. Anyway, I mentioned this because investing alone will not give you satisfaction in life. Take it from me. And I've said it before on the BBC, investing is the most useless profession in the world. All right. So I want you to put this into context. There's people out there who are nurses and doctors, and they're doing far more important stuff than I'm going to be talking to you about. Nevertheless, we need to put food on the table. So I'm going to give you all my experiences from the last 21 odd years from when I started my show on Bloomberg called Making Money and continue doing my bits on the BBC and all the rest of it. I'm going to give you 21 years worth of my own experience, all the expertise and experience I can give you from all my books on trading, some good international bestsellers there as well, I might say, published by the Financial Times and amongst others. Who am I? Well, in 2005, I set up my own private equity and hedge fund. We're located out there in Brook Street in Mayfair. We are a British company, but with funds incorporated in Luxembourg in the EU. Rothschilds are our bankers, Ernst & Young are our auditors. Just to give you a bit of background, whilst you're all making yourself comfortable, okay, one piece of important information is this. Whatever you do, please don't treat this as individual investment advice. I don't know each of you individually. All right. So don't treat this as individual investment advice because it's not equally a solicitation to buy Microsoft or PayPal or Square or Zoom or BP or whatever other stocks I'm going to talk about. All right. It is an education into how you should go about things. One other thing before we really get going, please leave now if you want to gamble. If you want to double your money by tomorrow, look elsewhere. We're not here to gamble. All right. Money is too important a subject matter for that. Like I said, I'm going to give you all my expertise from all the books, all the articles I've written in the FT, all my networks where I draw upon my group of other fund managers and all the things that I read and see. So you're going to get all of that. In exchange, I ask this of you. Please close the doors. Make sure it's quiet. Grab a pen and paper. Try to make sure nobody is using broadband other than you, please. Okay. And get that notepad which says making money. Oh, one more thing. I want you to grab a phone. because you want to take pictures of some of these slides. In the past, somebody said, oh, you've gone through the slides too quickly. Well, I'm going to do an experiment, okay? You get your phone, you click camera, you take a shot, you put it down. They'll give you ample time. Also, I want you to join me on LinkedIn, please. You will see more about me. You can do your due diligence about me. You will see that, as well as running my asset management company and some great commendations from others. I also look for companies for the British government. My job is, and I've done this for the last 15 years, my role for the UK government is also to look for outstanding technologies from around the world. Why did they ask me? Well, I was doing it in my own business. They felt I was good enough to do it for my country as well. And so what I do, I look for outstanding companies for the UK to invest in as well. Right, so I'm going to talk about two things. We're going to talk about a very disciplined process. I'm going to give you my latest holdings, my latest views on the market, and all bang up to date. Okay, some of you will have seen this before, but there's no harm in seeing it again. Our disciplined process in this webinar to get a return for all of you is this. You will hear lots of stock names. You might hear them on social media, on Twitter, somebody in an article, somebody on the internet. We put them all into a funnel. All right, we look to see, are they part of our strategies? And I'll explain what those are in a second, right? We then use some tools, which I'll share with you, to decide whether we buy, hold, or sell, and when do we exit, right? That's all it is. Names go into a funnel, and then we decide. How are we going to decide whether we buy, hold? Well, I'm going to introduce you to my holy grail, my secret vault, which is where I analyze all of these, all 8,000 stocks, okay, in the world. Well, in the UK and US, and this is what it looks like. And I'll tell you what, there's only about 100 worth putting your money into. The rest are just way too high risk. And I will go through all of this and explain what all of these terms are and how I narrow down from there, and what my return and performance is like. And you can expect, with that much filtration going on, where we take a load of names and then we work it out, what's the best of the best, what are the criteria we're going to use. I will go through all of that with you and really narrow it down so you've got the best advice from, okay, what are the subset of stocks which the Warren Buffetts, the George Soroses, the Goldman Sachs, the biggest analysts own? How do we get advanced information of these? And then we filter and filter and filter and filter. Only then, until we've got the very best candidates to put into our portfolio, do we do it. Okay, treat it almost like a football team. You only want the best players in the world. How many players should you have in your football team or portfolio? I'm going to show you that if you're risk loving, it's going to be 10. If you're risk averse, it's going to be 20. 15 is a good number. And I'm going to show you statistically and mathematically why that is the case. Several of the other things that I will show you during the course of this webinar. And I'll just give you a snippet now, so don't think I'm taking it away from you. I will show you what is in Bill Gates's portfolio, Kylak and George Soros, Jim Simons, Leon Koopmans, Warren Buffett's, and their top 10 holdings, because they're the only ones. Don't worry, I know it's gone off the screen. Don't worry, I will show you this in more detail later. And what some of the big hedge funds, those generating 51% per annum over the last 3 years. So 51%, 51%, 51%. On average per annum for the last 3 years, what do they earn, and so on. We will go through that, okay, as well. So I just want to give you a little snippet of all the things, and then how do we decide? And why are we doing this? Well, we're doing this partly because this is year-to-date returns, up 30% on the NASDAQ, whereas in the UK, my friends, most of you are in the UK on this, we are down, whoops, let me go back, we are down 20% year-to-date. Well, hang on. The bloody Americans are up 30%. We're down 20%. That's a 50% gap. And that's just this year. That's a 50% gap this year. That's a 50% wealth gap. No wonder those buggers across the pond, our cousins apparently, are so bloody rich. That's a poverty gap. That's a poverty gap for which there should be no excuse. Why do British people have to work so hard and not get the same returns and rewards for their hard work that the Americans get? The Americans are nicely up 30%. We're only up, we're down rather 20%. And yet we're obsessed in Britain of only owning British companies. Okay. And somebody's asked, why are the UK markets lagging? Well, that's a philosophical question. That's not, you might say, oh, this is just this year, Alpesh. This is just this year. No, it's not. This is Alpesh. There you go. There's my picture in 1999. 1999. I know my hair's gone and it's a lot whiter now. That's me in 1999 in the Financial Times. Okay, on September the 11th, 1999, saying you should probably sell up your entire UK holdings and buy only US ones. Does that make me unpatriotic? No, I'm British. I've got Americans working for me, and I repatriate the profits and spend them in Britain. Right? I make more money than my British investor compatriots because they're too busy buying into Aviva for God knows what reason, or Vodafone for God knows what reason, and so on and so forth. We are going to look at a global group. Trader, I'll answer your question a little bit later on 5G and so on. We're going to look at a global marketplace. Why? Well, for one reason, I want to be up 30%, not down 20%. I'm outperforming my fellow Brits by 50% so far this year. And that's not me doing anything. That's just the other companies doing it for me. And that's not just me saying it in hindsight, as I've got proof there in print, thankfully, of me saying it since 1999. So what are some of these year-to-date performances? And I'm not just talking about only investing in the US. We're actually going to invest in global companies. We might look at Chinese ones. We're going to look at British ones. We're going to look at anything which is listed on the UK exchanges or the US exchanges and is global. So what is the year-to-date performance? Well, we're going to pick from some of these. Alpesh, wait. We've missed the boat, surely. Missed the boat. Remember how I started this webinar? Amazon's already up 72%. Well, people have been saying I've been missing the boat on Amazon since I started my hedge fund in 2005. And Amazon's been the easiest money we've made in our fund, because all we have to do is bloody buy the thing and just sit back. That's why hedge fund managers are hated, because we mainly sit back and do nothing. Let others like Amazon do the hard work. Microsoft year to date, up 33%, Apple up 56%, Facebook up 27%. Is it too late? Have we missed the boat? Should we look at some of these laggards? Should we be looking at oil and gas, which is down 38%, but surely is about to change? It's a laggard, isn't it, Alpesh? Or maybe discount stores like Walmart, because, well, it's all about to change. Are we going to gamble on news flow and COVID deaths day by day and just work out which directions they're going in? Or is it time to get into some of the big banks which have been so unloved? I'll answer all of these questions. By the way, I do own shares in PayPal, MasterCard, Visa, Apple, Microsoft, Adobe, Google, Amazon, Facebook. But I don't just own the shares. I own leverage of them, and I'll explain that and how. Because when I think something is, well, in poker, a royal flush, I do double down, right? How? Well, when I've got the bloody cards in my hand and they're really high probability of success, and I'll discuss statistically how we work out success, then of course you double down. You don't go timidly into it, all right? For the world that we're going to look at, this is the universe from which we're going to pick. We're going to pick equities, okay? This is the universe from which we're going to pick in the world. So here it's the world over the last 3 months, excluding America, but whilst it's excluding America, but it does include every single stock listed in either the UK or the US market. So when, for instance, you've got Israeli companies over there, and it's probably a tech company, as most Israeli foreign companies are tech, then it is listed in the US. So you buy it the same way through Hargreaves Lansdown, AJ Bell, Halifax, Barclays, stockbrokers, whoever you use, as you would buy HSBC. Were you minded to buy HSBC? All right. So so how do we decide when we've got a whole group? Let me put it this way. I entrust my son's inheritance to a bunch of companies. Those companies are run by individuals. I want those companies and those individuals to be the best in the world. If I want them to be the best in the world, I hire an interview from 8,000 global companies, not just from the FTSE 100 or the FTSE 250. I'm not an idiot. My number one job is actually not so much to make money as not to do something stupid. And the stupidest thing you can do is to recruit from a very narrow gene pool. So instead, I recruit my squad of 15 from a global universe. Little wonder I outperform the market, not down to any skill by me, but just by not doing something stupid, like investing only in a very tiny talent pool, but instead doing something not so stupid, which I've been talking about for 21 bloody years, like making sure I've got Microsoft people working for me, Apple people working for me, because it's my son's inheritance, which depends upon it, and my pension. So you better bet I'm not going to simply look at a narrow talent pool. You better bet I'm going to look to make one hell of a return. And what are the maths behind it? What are our financial goals? They're these. I'll run through these for you right now. Assume you plan to invest over 10 years. And with my help, actually the help of the market, not so much me just helping you not to do anything stupid, okay? And with my help, let's say you make 20% per annum. Most of that will come from just the market rising. Some years you might make more, some years you make less, right? You can't beat a negative market. Even I can't beat a negative market. Some years you make more, some years you make less. But on whole, we're averaging 20% for UK stocks, 40% for US. Why 40% for US? Well, did you see the chart I just showed you? For America, it tends to be a lot bigger anyway. Nothing extravagant, nothing pessimistic. Let's say you've got 100K. Now I'm going to do an example in a second where you've got a lot less than 100K, where you've got just 10K. But bear with me for a second. Let's say you've got 100K in your SIP, your ISA, for yourself, your child, whatever. Okay. You also, or maybe in your company. Your company's got some spare cash, right? Let's say you plan to add 1,500 each month because you're quite well heeled, quite well to do. Well, with my help on those numbers, you'll have over 1 million in 10 years. You'll have turned 100 into 1 million. 100 into 1 million. How? Show me the numbers, Alpesh. Okay, I'll show you the numbers. They're the numbers. They're the numbers. 100 into 1 million, right? You start off with your 100. You're adding a bit of capital, which is this line here. But this is what happens with the 20% per annum on average. That's what happens. Okay, that's my goal. My goal for my family is to turn every batch of 100 into 1 million every 10 years. No, it's not, because that's 20%. I'm not looking at 20%. I'm looking at those US stocks, and you just saw some of those and the returns they generate. I'm looking at 40%. So I'm looking to get that return a lot sooner, right? I know it is the stupidest job in the world, and it's the easiest, hardest money you'll ever make. Let's assume instead you've only got 10K to start with. This is your business plan. You've got 10K to start with, right? Maybe you're in your 30s, you're in your 20s, you started saving late, you've got a low income job, doesn't matter. You plan to add 6K a year. So 500 a month, all right? Then this is what your return looks like now. Because you're starting with just 10K, let's say we're going to take a 15-year horizon, right? 20% per annum, keep it modest. Then you turn that into nearly 600,000 over 15 years. That's where my son has started out. In his junior ISA, because you're only allowed to put in, well, last year it was 4,000. This year it's 9,000 roughly. So this is where my baby son, who was born in 2018, has started out. Right, he's there on the journey, and he's on track. He's actually exceeding this somewhat, and I'll show you his portfolio later. And I want, by the time he goes to university, the spoiled little brat to have $600,000. I'm not going to just hand it over to him. My biggest problem I want to have when he goes to university is how not to spoil the little so-and-so. That's the biggest problem anybody should have, not where the hell's the money, right? So those are our goals. Can we achieve them? Well, we've been doing it. It's all been independently verified by a Financial Times Investors Chronicle award-winning company called Ionic. You might have heard of it, better known as Sharescope. I've been doing these picks, not just 2019, not just every single year, but actually since 2004 for them, and been achieving this on the UK, and for the US, it tends to be double that. All right. So what do I have at the moment? How do we pick these? We don't just want names. You want to learn how to fish. You don't just want to be given the fish. Well, these are some of the things which are in my son's portfolio at the moment. Why the hell Premier Oil? Well, that was a special situation. I'll discuss special situation strategies in a second. When price of oil dropped, got into Premier Oil. So we'll discuss special situations in a second and how to evaluate all of these. But I want to show these to you so you don't think I'm only teasing and not giving the actual names, right? So these were some of the returns. Now, I will also in this webinar tell you why leveraged Amazon, why 2 times leveraged Amazon. In other words, an Amazon goes up $1, I make 2. If it goes down $1, I lose 2. A bit more risk involved than that. But why did we do that? Why is that in the portfolio other than the bloody obvious reasons? And by the way, this is just all since March when I gave my talk in Hammersmith before the lockdown. Gave a talk at the investors show, and I told people what I'm buying. Best of the best was more recent than that. That was just about 6 weeks ago. Okay. And these are the more recent returns. I created a portfolio during that talk and told people what I'm looking at. And this is how it's done. So how do we go about doing this? Square was more recent, by the way, as was Net Company as well. So how do we go about this? How do we decide? Well, we've heard these names. Is it too late to get into these? Have we missed the boat? right? I'm still on him. Have we missed the boat or not? So I'm going to drill into that, but I'm also going to do it by showing you, well, how do we pick stocks? How do we filter out what Warren Buffett's got in his portfolio, or Bill Gates? Where does that fit in, right? Rather than just me. How do you pick that? So you've got a proper process. How many stocks should you have? When do you know when to sell? We're going to go through all of that. Can I ask you one thing? And I always do this in my webinars. Right at the end, can I tell you one of the things that my hedge fund is doing? Right at the end, you don't have to stay for the last 10 minutes. I always ask you permission for this, only because sometimes people go, oh, you get great content. But in the end, Alpesh, whilst you gave great content, you talked about yourself and what your hedge fund's doing, what you're doing in the future. You don't have to stay for the last 10 minutes, but if you don't mind, I'd like to do that right then. Let me very quickly, in 5 minutes, go through the main problems in investing, and then part two, give you solutions on the bigger returns, all right, and what we're looking at, what we're doing, and share some of those holdings of Buffett and everyone else in a second, right? So 5 minutes, big investing problems. These are them. This is how most people buy stocks. They panic buy. They don't have any rhyme or reason. They pick anything they see. We've got to get away from that. We're going to have a proper reason to do it. They also don't know when to let go. So I'm going to show you how to let go and when to get out. All right. And I'm going to teach you that in a second. They just don't know how to let go. They hold on too long. As well as the other problem people face is rubbish fund managers. I want you to be your own fund manager. I want you to be your own fund manager because you can be better than an overpaid fund manager. And because I've been mouthing off about this for so long, the FT said to me back in 2004, oi, you talk a lot, Mr. Patel. Come up against some fund managers, right? And I did. And I said, I'll do it if you run it over 12 months, check my performance against theirs. And at the end, when I win, put it on the front cover of your business section, your money pages. And they did. And I won. And they had to. All right. And I'll tell you who came number 14, just above the editor's cat, because the FT thought it'd be funny having a cat there because they'd be able to embarrass me. They couldn't. They embarrassed Neil Woodford because he pretty much came on a par to the cat. And in 2017, well, he was rubbish back then. He remained rubbish. And they had to concede I was the best. Right. Why am I saying this? I'm not trying to be arrogant. I'm saying this because if you're going to sit here and watch a webinar from someone, you better know that you can be a fund manager because I can, right? Because I can. So you can. It's that simple. And I'm going to teach you why it's important you're your own fund manager, because the other problem you have is at the moment you're trusting your IFA and the fund manager as well, and they're handcuffing you to be poor. Why? Well, look, this is a typical fund. You might even have a fund like this, UK listed equity growth fund. It's a common fund, UK equity growth. Ooh, sounds important. And they'll have all these diamonds and numbers out of 10 and letters, and they'll have words like booster. Okay, well, its 3-year performance is minus 2.3%. But Alpesh, COVID, of course, it's down 3%. Oh, okay. You want to give them the benefit of the doubt, even though they're supposed to be a growth fund? This is what they hold. This is what you hold in your pension when you give it to a pension fund manager and don't look yourself. They have to disclose this to you. They've got 48 holdings. First of all, why the hell have they got 48 holdings? Well, because they can then churn it a lot and give lots of brokerage commissions and get kickbacks. Anyway, that's a separate story. Their top holdings in UK growth are BP, oil, before the oil crash. They thought oil was a growth industry before the bloody oil crash. That's how good they were. Okay. In fact, they've got so much bloody oil. They've got Shell as well. Well, Shell and BP pretty much run in lockstep. So this guy's a total idiot, not half an idiot, a total idiot, right? They thought tobacco's a growth industry. So they put some money. That's their top 10%. That's yours, not mine. When you give it to a fund manager, this is what they're doing. It gets worse. Not only do they in UK growth have basically FTSE 100 and FTSE 250 stocks. How's that growth? What I would have thought AIM or fintech, a bit of cyber technology or health technology companies might be growth. No, not to these muppets. They think tobacco's a growth industry. Well, Sir Walter Raleigh died about 300 years ago when it was a growth industry. Gets worse. You're paying 10% of your assets under management to be kicked in the teeth by them. This is the total cost. If you invest £10,000, this is taken from their fact sheet. Never mind small print. They have to print this in big writing, but nobody reads it. £10,000. The total cost, if after 5 years you cash in, which is their recommended holding period, right? Because there's barely a 5-year period where the UK markets have not broken even. Well, in 5 years, I don't want to break even. I want to have doubled or tripled my money. Right? And if you don't think that can be done, go look at Netflix, Amazon, Microsoft, Zoom. See what's been happening over the last few years in these markets. All right, in technology. These numpties are not even putting you in technology companies. Right? So you're paying £1,000 in fees out of your 10 grand, 10%. every 5 years. 10% every 5 years is going in fees to a fund manager who's a little bit better than a cat, and you could do better. That's a major problem. That's why I want to educate you, please, into being your own fund manager. I want to empower you, and that's what this webinar is. It's an educational one. And we've got to solve another problem. It's all very well me saying this and trying to hype you up and pump you up, but where are you going to get the information from? Because there's a rich-poor divide in information. People like me as asset managers, we get things like this from Goldman Sachs, from Peter Oppenheimer. There's his email and phone number. Call him up if you want. Okay, investing in 2020 and beyond. Now, this might be a self-fulfilling prophecy, whatever they say, because they can move billions. Well, I still need to be aware of the self-fulfilling prophecies and be able to share them with you, right? We get access to it. There's a rich-poor divide between the information I get and the edge I have and what you have. Goldman Sachs ain't sending you that. UBS are not sending you their house view, okay? The European conviction list from Goldman Sachs of their best and brightest ideas, they're not sending you, my friends, right? They're not sending you their top-of-mind information about coronavirus. Goldman's are not doing that. So I've got to share it with you. My job is to be like Robin Hood. Take this data, work out what the most important bits are, and then give them to you. Why? Well, it's no skin off my nose. No skin off my nose at all, right? UBS Bear Market Guidebook, March 2020 from the Chief Investment Office. They're not giving it to you. So we've got to make sure you get your hands on it. So how are we going to do that? Well, this is how we're going to solve that problem. And that's what I want to do now. Let's look at the solution part. Let's look at what looks good. Why? What does Goldman's look at? What do their top analysts look at? What does Buffett? How do you get a proper systematic approach? That's what I want to give you. I want to give you that systematic approach. And I believe there are 6 or 7 strategies worth looking at. Let me start with one, which I created for somebody who wanted slightly higher risk. So we're going to go from higher risk and higher reward to the safer stuff. Like I said at the start, when I did a poll, people said they want the higher risk on safer stocks, and some said, no, we just want safe. So we're going to cover both. Let's start off with higher risk, higher reward, right? Assume, this is one strategy, assume you want to add more risk to your return to your portfolio. Assume you've got $20,000 risk capital. Now, if you've got only 2,000, divide everything by 10. If you've got 200,000 or 2 million, you get the idea. So let's say you've got 20,000 risk capital for higher risk returns, aside from your safer pension and rainy day investment. So it's separate to that. Okay, this is the return histogram for Microsoft. On any given day, we're not going to look at a day, it's between somewhere down between 15% to up 15%. Obviously, the frequency at which it's up 15% is very rare, down 15% is very rare. On the whole, it generates 0% on average. Okay, on average, typically 0% on any given day. On any given 5 days, it's up about 1% historically. But there's a range of down 16 to up 19%, right? On any given 20 days, you get the idea. Any given 50 days, it's up 10%. But on average, that's the mean. But you could be down 17 or up 38. On any given 250 days, you're up between 13% to up 80%, right? But the average is 46%. How do we use this information? That's not enough. Speaking of A-levels, I got the maths prize at school. That's not enough statistical data for us. How are we going to use it? We're going to do this instead. We're going to do this. We're going to take this information. There's a 95% range in 1 year that Microsoft will be down, will be somewhere between minus 28% to up 179%. Where do we get that from? Is that its historical returns? No. Historical returns are too few, because history is only last year, the year before. That's too few. What statisticians do is they take the actual historical returns and then they do what's called a log normal random walk based on the actual historical parameters. So it shows, given what's happened in history, what's the worst that could actually happen, but didn't happen, but could. That's more important, because what happened in history is actually a poor guide to what will happen in the future. What's a better guide is what could have happened. Realistically and mathematically, there is a 95% probability that it'll be between minus 28% and up 180. Well, I don't care about how much it might be up. I'm worried about this figure. So what do we do with this information? We do this. Let's say we therefore assume there's a 5% probability of it being below 28% or above 178. No, let's be even more pessimistic. Let's assume there's a 5% chance of being down 30%. All right? Let's assume that. And we've got a bit of maths on our side there, okay? On our side there. If we bought, maybe it was asked, most brokers only allow you to buy US stocks in pounds. That's not true. How do you hedge against currency? Because I don't need to hedge against currency risk because I want to hold some of currency as a risk diversifier in its own right anyway. Okay, so I don't have a problem with having dollars or pounds when there might be some currency back and forth, because that exposes me to dollars, and that's perfectly fine by me, and it's been proven very good over the last few years. But even if it didn't, it comes out in the wash. Some years you're up, some years you don't. It doesn't actually matter. When something's going up 180%, a currency moving 5% here or there is neither here nor there, right? If we bought 300 shares in Microsoft, which is trading at $209 per share, then that's $62,000. That's a lot of money. We haven't got that. Okay, 300 times 209. If it dropped 30% of 62,000, you'd lose $19,000, which is your risk capital. Remember, $20,000 your risk capital. But you don't have that $62,000 to buy the shares in the first place. You've only got $20,000. So what can you do? Remember, this is higher risk, but on a safer stock. Why is Microsoft a safer stock? Because we've got the statistics and we know there's a positive skewed return. That's why it's safer. That's why I'm picking Microsoft and not Barclays Bank or Vodafone or Aviva or Legal & General. I'm picking something with a positive skew. Okay, but what am I going with this? This is where I'm going with it. Let's assume there's a 5% probability of a loss of 30% in a year. If we used a leveraged product like a CFD, the equivalent of 300 shares in Microsoft, we would need a deposit. So there you go, buy Microsoft at $209, 300 shares, which is 62,745 notional. Remember what I said? So we're buying 300 shares, 62,745. But because it's a CFD, we'd only need margin, a deposit. Just like when you buy a house for £100,000, you only need a £10,000 deposit. We only need a deposit, according to this broker, of 2,000. But that's deceiving. And this is why 78% of people lose money with brokers when they trade CFDs, because they look at the wrong bloody numbers. They wrongly look at this number instead of that number. So let me take you through it. We would need a deposit or margin of 2,822 with the broker, plus, of course, funding charges, which are going to be small anyway. If Microsoft goes up $50 per share in the course of a year, i.e. 25% up, which we know it tends to, but let's say, let's assume for the moment it does. It's a below average return for it over the last 10 odd years, but let's say it did. So 50 divided 209, 25%, you'd make $15,000 because 300 shares you own times $50 per share is $15,000, i.e. 75% return on your risk capital of $20,000. If it drops 30%, and there's a 5% probability, actually it's less than 5%, but let's assume 5%, you're out of pocket your risk capital. However, when Warren Buffett was asked, what would you do if Microsoft dropped 30%? He'd said, I'd buy some more. There are a few stocks I would buy more of. That's why I'm looking at Microsoft as an example. It's one of the few where I wouldn't take my stop loss. I'd add to my losing position. There's only 5 companies I do that with, and I'll share that with you. So the reason people lose money when doing this is they look at the margin and say, oh, it's only 2,000. I've got 20,000. Let me buy more. That's what the broker wants you to do. Notice how the broker's deal ticket here, and I've taken the example from IG Index, but you could have picked any ETX. You could have picked any UK broker. Okay. They don't tell you this part. What's the probability of it dropping 30%, 5%? And if it does, how much could you lose? 20 grand, because they want you to lose that money quickly. They want you to be over leveraged, overextended. Every single hedge fund that's ever gone bust, or fund or bank or the credit crunch, happened because people had looked at this number, not how much they could have lost if the unforeseen happened. We're going to protect against the unforeseen by having our 20,000 liquidly accessible to us, just in case the 5% happens. If the 5% activity doesn't happen, then what we're looking to do is try and make a 75% return on that capital. What are the risks? Well, the risks are you can lose all your capital if Microsoft drops. What if there's a flash crash? Okay, what if it drops more than 30% and you've got no more money in the world? So you can't add into your loser. What if you get your calculations wrong? I'm just showing you some maths. I think it's simple, but you might not. What if the broker suddenly decides to charge you lots and lots of interest? What if they're not regulated or trustworthy because they're from Cyprus? God forbid. This is for sophisticated, high-risk investors. But I wanted to give this example. But what are the numbers? That's Microsoft. Let's look at some others. Before I give you the other strategies and other stocks I like and what Warren Buffett owns and all the rest of it. This is just one strategy. Well, for Apple, the 95% range, well, there's a 5% probability it'll go below 30%. Okay? So for Apple, it's 5% chance of dropping 30%. So it's just like Microsoft. However, Facebook isn't. 40% could be the drop. There's a 5% probability it could drop 40%. Alphabet, 5% probability it could drop 40%. Okay, so I've given these other figures, right? Amazon, and if you want more of these data, it's on my free Telegram channel. That's my Telegram channel. It's free. I post this on there at times. There's my Telegram channel. Okay, and you'll see various bits on there that I post, things like that, and important pieces of information. Okay. Where was the last one? Anyway, it's scrolling up. Right. So with Amazon, 40%. Now, here's something interesting. You can, with just £10,000 margin, control $250,000 of portfolio, but you shouldn't. You should set aside the risk capital. With £10,000 margin, controlling £250,000 portfolio. If you had Amazon, which has a 5% chance of dropping 40%, well, if it drops 40%, that's £100,000 you're out of pocket. Now, you might say there's only a 5% chance of that happening. Well, so they said that in the credit crunch. I don't want to take those risks, but that's just to show you how to do it. If you want that extra zip and leverage, then use the positively skewed stocks like an Amazon and Microsoft, and set aside the risk capital. Don't look at the margin requirement. Look at the probability of loss and the amount of capital. That's just one strategy. That's higher risk, though. Let's look at more lower risk and what Goldman's and Buffett and everybody else owns. Remember, I said all of these. So how do I put these stocks into my portfolio and come to these conclusions? Okay, how do I put it into the top of my funnel as I showed you earlier? Well, strategy number one is to get ideas. These are ideas. These are not things I'm going to buy. These are ideas. I might look at the guru buys. I might look and share with my students what Warren Buffett owns. That doesn't mean I go out and buy it, okay, because he might be rubbish. He might be past the hill. But it's just names I put into my funnel, then to analyze on my spreadsheet, okay? So whilst I look at what he owns and what John Kim of the hedge fund Night Owl, which is up 51% per annum, might own. That doesn't mean I go out and buy it, okay, blindly. What it means is I've got to go and put it in and look at these other factors. What are those other factors? I'll tell you in a second. I still need to filter it, right? And in case you want to know not just Buffett, but the other gurus, here's a list. Feel free to take a picture of the S&P 500. Dark green means the higher concentration of gurus owning a stock. Light green or white means hardly none of the gurus touching the bloody thing. Okay. So Amazon, and by the way, that's United Healthcare, Berkshire Hathaway, Fox, Viacom, right? These are the names, eBay, Facebook, that the gurus tend to have. Who are the gurus? Well, they're ones with a track record of managing billions and getting it right. All right, people like Leon Cooperman, Gene Simons, and so on, Bill Gates Foundation, and so on and so forth. And people like that, Bill Ackman, and so on. If you want to know some of the specific things they hold, but that I put it in the top of the funnel. So don't get carried away. Number of stocks, these are the number of stocks they've got in their portfolios, and these are their top holdings and the percentage of their holdings. Take a photo. I don't want people to think, you didn't tell us, okay? Here we go. Boom, I've taken a picture, I've put it down. Now, that doesn't mean you go out and buy it. That'd be the stupidest thing, because you don't know how to get out of it and you don't know whether it's worth buying. Remember what I said earlier. It's not about that. It is about it's not simply buying it. What we need to do is that bit. Remember what I said earlier. We need also to look at and determine what we're going to analyze, right? These are just names that go in. These are just names that go in. So when we look at this, okay, we need to determine, right, where are we going next with it? I'm not going to go through every single strategy, but one of the other ones I do want to go through on this is one of the things that I want to go through. Whoops, let me just go back there. On this, remember I said the names go in at the top. So just because Buffett's got it and everyone else, well, that saves me and narrows down the stocks I need to analyze. But how am I going to analyze them? That's what I want to go back to and explain to you as well. Okay, what are we going to go back to? What we're going to go back to is putting it in the funnel and then analyzing. Investment strategy 2, put more names in. I leverage big on low risk. What's low risk for me? These are some of the things I hold. What's low risk? Well, I've said before, Apple is, Amazon is. So I've bought the 2 times leverage exchange traded product on them. And these have gone up a fair bit. What's low risk? Best of the best. Why? And it went up 100%. Why? Because we did the valuation analysis. What did we do? I'll explain that in a second. S&P 500, 3 times leverage. Why is that low risk? But why have I then leveraged it? I leverage lower risk, okay? Because I'm looking to target 40%. Square, Netcompany, PayPal, Zoom, right? So how do we do that? How do we come to some of these stock names and conclusions? How do we evaluate them? Why have I got these to get that 40% that I'm after? This is some of the ones in my son's portfolio. These are some of the ones in mine. Feel free to take the pictures. How did I decide upon these? Well, I'll tell you. For me, I scan UK, US, global stocks. I monitor infrequently. I don't need to look at it every single day. One screen, not one strategy. 20 stocks I want to hold. Max. Actually, 15 to 20 max. How's that done? Well, I want to diversify. I want to make sure they're not correlated. Actually, I'm going to come back to that one in a second. What I want to show you first of all on this is, there we go, that one first. The other strategy I want to use when I put these in is, what are the banks telling their richest clients? Let's share that with you. For instance, that red line at the top tells me what the analysts at the biggest banks are telling their wealthiest clients and the price targets are. This was Petrobras. Oil company out of Brazil. You might think, are you an idiot, Alpesh? Why would you want that? Well, after it collapsed, because the oil price collapsed, the banks were still projecting quite a high target, over 100% return. Analysts are over optimistic. I don't like them. Notice how they're always over optimistic, but even allowing for their over optimism, I should be able to get 100% return in that one. So then what happened? Well, this is what happened. Fast forward to today, and it pushed up to 11 from the previous 5. Yes, doubled the money. Right? So that's one. But that wasn't done based on that alone. I then had to analyze the stock before I bought into it. Disney, in April, you've been on my webinar in April, the analyst ratings were, there's a 44% upside. The price target was 144. It was trading at 99. Okay, what happened? Well, today, 118. So it went from 99 to 118. Half of that 44% upside already achieved. Take Viacom. April was trading at 12. The target by the analyst was 37, 190% to the upside. Moved forward, moved up to 24. From 12 to 24, it doubled. And you'll remember it was also one of the ones that I said earlier. Remember, it was one of the ones of the gurus. That wasn't enough. We still need to analyze it and filter and filter. We don't just trust analysts. We don't trust one way. We filter. How are you going to do? United Healthcare, remember the most popular one? That was 242 in April, 323 was the target, 33% upside target. Today, up to 303, pretty much there already. Well, what are the banks telling their biggest clients? Yes, I want to know what Merrill Lynch is saying for a stock when the buy rating came as well. I need to know that. I need to know how recently they gave the target, what the upside target is. All of this. We can't just rely on one bank or one analyst. We need to know their track record in that particular stock. How recently did they give it, and how much does that tie in with others? Because it may be a self-fulfilling prophecy, but we want to ensure others agree with it. What do big banks tell their clients? There's a very important thing, which is very important indeed because of this. It's called the Altman score. I want to, when I got those stocks going into the top of the funnel rather, and I look at the filter, I also want to look at the Altman score. What's that? Well, it's this formula. Don't worry about what it is. I'll give you it for the stocks in a second, right? It looks at the working capital. Look at the world now. Working capital is so important. Retained earnings, i.e. the profits, the money in the bank is so important. Assets are so important. Sales are so important. So what do big banks tell their clients? They look at the Altman score. And if it's 7, 8, or 9, Altman score. If it's 2 or 3, that's good. If it's below 2, we start worrying. Okay, as well, right? That's worrying. What else do banks tell their wealthiest clients? Well, this is a slide from Goldman Sachs Asset Management. So I'm going to share. Whoops, why does it go blank? Stupid thing. It's gone blank. Okay, can't zoom in for a second. Doesn't matter. Let me tell you, what do Goldman Sachs tell their wealthiest clients? Well, this is what they tell them, and let me show you what they're saying. What they're saying, Goldman Sachs, right, returns. For most sectors, we analyze Croaky and focus on identifying Q1 Croaky stocks. The Q1 being the top quartile, the top 25% of stocks by Croaky. What's Croaky? It is this. What is that? It is cash flow. Why is cash flow so important? Croaky stands for, by the way, cash return on capital employed. We need this number. I want that number to be above 10% and as high as possible. It tells me that a company has lots of assets, but more importantly, is able to generate cash and working capital from that, from their assets. In other words, it can generate cash and has working capital, a bit like the Altman. And you know what Goldman Sachs told their wealthiest clients? The stocks in the top 25% of all highest Croaky generate 30%. Would you like 30% per annum? I would. This is what they're telling their wealthiest clients. I know this. So what do? I look at not just what is in Bill Gates or Bill Ackman's portfolio here, right? I swing across and I say, right, what's the Croaky? That's how I pick mine. And I put into green anything above 10, and I put into reds anything that isn't. And I've got my Altman, so I stay clear of those. My number one job isn't to make money. My number one job is not to do something stupid. So we look at that. We put those in. That's how I came to the names I've already given you, right? I'll give you some more names. I'll give you those names again. Investment strategy 6. What are big hedge funds doing? Well, like I've shown you here, just because I've got these names doesn't mean I just blindly buy them. I still need to look at their Croakys, their Altmans. What else do I look at? I will look at the data from hedge fund ownerships, and I'll look at Bloomberg terminal on it. I will look to see what are the biggest hedge funds. Now, you won't be able to see that because it's really small on screen, but we'll look at the ownership, the value owned by the biggest funds. What do they own in Amazon, Microsoft, Facebook, Visa, MasterCard, Alphabet, PayPal, Salesforce, Alibaba, Netflix, Twilio, Charter Communications, which I own, Adobe I own, Apple I own, Square I own, Ring Central. I don't own Ring Central, actually. Right? So it then goes in. We will look at what hedge funds are doing, but that's not enough. It's a necessary but not sufficient condition. It's necessary to know that hedge funds are very positive. They've been buying into Globant, Argentinian tech company, been doing very well for me and my son. Right? So it's in our portfolio. It made our team. Cadence made our team. Right? For how long? Well, I keep life simple. I do this. Either it drops 25%, trailing stop loss, okay, or 12 months are up, whichever happens first. It's as simple as that, right? Simple as that. I've told you, remember it. Cadence, I look at news sentiment. It's sufficient. It's a necessary condition, but it's not sufficient. It's necessary to know, is there positive sentiment? Okay, what is the news guidance, right? But it's not enough. That is not a reason to buy. The reason to buy is I need to go through valuation. I go through what I call my valuation, price earnings ratios, growth, year-on-year revenue growth, earnings growth, momentum, income, dividend yields. Why? Because all these things, research shows, will add to the performance of a stock. I don't just want undervalued companies, because undervalued companies might be undervalued because they're rubbish. But I don't just want growth companies because they might be growth based on momentum and they could crash because they're overvalued. So I want undervalued, high growth companies generating income and with a momentum, okay, a trend as well. On top of that, I want high Croakys and I want strong Altmans. There's other factors that have got to be in there because I'm filtering the best of the best. I want Sortinos and Alphas. What the hell's that? Well, that's something which is used almost uniquely by the hedge fund industry, not by long-only fund managers. If you ask a dimwit long fund manager, like I showed you earlier, they won't have a bloody clue what those are because they're rubbish. This is what hedge fund managers use. What is the Sortino? A Sortino measures the volatility of a company and its consistency to hit an average return. So if something gets 100% per annum, well, it's no good if 5 years ago it was 100%, well, it was up 50% and then kept dropping each year. We want the average that it generates to be consistently hit. We don't want it to vary and have lots of volatility around. So higher the Sortino, the better. Ideally above 1, but above a half, and it gets a green light from me. Alpha means by how much does it beat the market. Now, when I'm a hedge fund manager, when we have institutions like Aegon and AXA who invest in us, the founder of Cobra Beer is investing in us, the founder of New Look PLC is investing in us, their family office people, the institution's offices, they will say, what's your Sortino? What's your alpha? Okay, that's your, by how much do you outperform the market? If a company similarly can be treated that way, then we want to know that. And we want those to be green light. We want those to be green light. And we want these to be green light, which is value, growth, income, momentum. We want the croaky. Do you see how I'm filtering? I don't just want them to have straight A's at GCSE, A level, a first from Oxford. I want them to have a PhD and a Nobel Prize as well. Why so tough, Alpesh? It's my son's inheritance. It's my pension at risk. That's why. Okay. So what are the big numbers? Well, I'll tell you, these are some of the things in my portfolio right now that I particularly happen to like based on all of that. But that's not good enough. That's just today. Tomorrow it might change. So you need to know how to do this yourself. Okay, I've shown you this before. You need to know how to do this yourself. How? Like I said, this is what I do. Okay, why do I only pick 20? Let me tell you, there's something very important I want to show you. Oh, by the way, top analysts. Brian Schwartz. Okay, these are his picks. 60% average turn of his stock ratings in the past 2 years. Brent of Piper Sandler, 36% average over the last 12 months. Now, this doesn't mean I just go out and buy them. This tells me I put it into my funnel and then analyze it for Croakey, Altman, and everything. So even these analysts, we can do better on. What I want you to look at is this. Okay, this. Depending on how close you are to retirement, this is how you divide how much equity you should have and how much fixed income. I believe I'm 25 years away from retirement. Therefore, I can afford to have up to 100% in equities or as little as 75%. I'm going to go 100% in equity. So I want you to know that. The other thing I want you really to know is this one. Okay, 15 stocks on average. You after about 15 shares, you pretty much removed all the risk from your portfolio. If you're really risk averse, have as many as 40, maybe 20. If you're risk loving like me, you'd have as little as 10. All right. I want you to see that as well. That's my little, we keep that in the cloud for my students, that whole database there, and it's updated so that they get the Croakys and the Altmans and everything else. Let me tell you what you need to be doing. You need to be diversified so everything isn't correlated. Well, I give correlation numbers. Of course, Amazon and Apple are correlated, but they're not as correlated as you might think. Stop loss in performance, 25% or 30% if you wish. Quality company, so I'm less worried. If the market falls, my companies, because their quality got good Croakys, good Altmans, good Sortinos, good Alphas, should fall less. They might fall. Look at Microsoft in March. Might fall, but fall less and recover more. And there'll be a flight to safety as other people leave. I want there to be a market crash. You know why? Because mine are the companies that when there's a market crash, there's a flight to safety. Which are those companies? Well, they were the Square, Amazon, Apples, and so on. And if the market rises, well, people put money in them anyway. Okay, I want to, if they go up, I might add to winners. I never add to losers unless they are one of my 5, like I said, quality companies: Amazon, Apple, Alphabet, Facebook, or Microsoft. Those are my add to losers. And nothing else you add to. 12 months I hold. Don't do this in 9 to 5. Do it in calmly at the weekend. 1 hour to find that 10 investment shortlist. Okay, that's the holy grail. Tends to be that spreadsheet of 8,000 individual equities. I've given you some names in this as well. So I started doing all of this when I was at university. That's me last exam. Perfected the strategy, won awards as you've seen in the FT. For that, who then asked me to write books about it, including Investing Unplugged. Don't buy the book. It's 20 years old, and whilst it's phenomenal, I'm giving you the best bits in this webinar, and I only get £1 in royalties anyway. Winning those competitions, people then started, I mean, the obvious thing to do is set up my own fund. If you're any good, so we set that up, which is open only to institutions, so we're not pitching the fund to you. Can't. It's a criminal offense. I'd go to prison if we had retail clients. You're not allowed. You can only have institutional investors. That's why I want you to be your own fund manager. And then people said to me, well, teach us how to do this. And for years we said, no. There's no. Why would we teach people? There's no money in it for us to teach. Then the whole fintech, edtech, educational technology revolution came along. And we realized, you know what, I said to people, what do you want? They said, well, the ideal is we want to learn at our own pace, videos, articles, whatever, at our own pace. We want one-to-one attention with you. And I said, no chance, I ain't got the time. We want it to be convenient, do it from home. Well, COVID proved that. Want it from a regulated fund manager. Okay, we want no travel costs, not connected to any broker, so there's no conflicts of interest. I want the info that Goldman Sachs might give you, want ongoing support for life, but no monthly fees, daily fees, weekly fees, no subscription charges, want lifetime updates, want access to you one-to-one, WhatsApp, and so on and so forth. When I say hold for 12 months, I mean I then reanalyze. After 12 months, we do it again. Okay, we analyze, and some might stay on, like an Amazon, and then it goes on the year after and the year after. But every 12 months, you don't just buy and hold forever. You reanalyze every 12 months, okay, is what I mean. Daily updates, alerts, newsletters, and we want software. We want several pieces of software, but no cost to it. The same software you've used, the approved list, but also software to get the data that you said if we want to do our own research and not just rely on yours. And I said, fine. And we didn't do anything about this for a long time. And we realized, you know what? We've got the potential to spin out a company to offer all of this. Given that I'm a hedge fund manager, given that I'm a professionally trained communicator, I used to be a barrister. And I left all that to invest full time because it's more lucrative than being even a lawyer. Paid by Bloomberg for my own TV show, by the Financial Times for my column. I've had 200 investment columns published in the Financial Times. If you're interested, I was paid £1 a word. I know it sounds great. My wife thinks that's why I talk so much. I'm a visiting fellow at Oxford University where I lecture on behavioral finance and won awards in the FT. And we realized we've got no competition. We should spin this out. Given that there's such a big demand for people to learn for themselves, we should actually kill the fund management industry and have people running their own pensions, learning how to do it, instead of just having fund managers who put all their money in BP. And so I've been plugging this away and saying this is what people should do. I've done it on the BBC. I've talked about it every opportunity I get, just as Richard Branson would if he could as well. And we thought, technology's caught up. We can have WhatsApp conversation with people. We can have Zoom calls one-to-one with students. We can have Telegram, which is like WhatsApp, where I can send people, what I'm seeing, what I'm buying as soon as I'm buying it, what Warren Buffett's buying, or Bill Gates if they want to know, but also access to the whole spreadsheet as well, which is really the holy grail. I mean, that's the way to do it. Analysis of all the equities and what we like, why we might like it, what we don't like, and so on. Anything with a 6, 5, but a 6 or lower we don't like, would never put in other unless it's one of the 5 quality companies like an Amazon. Okay, and then we've got such great reviews. I thought, you know what, we've got to spin this out of the hedge fund. So we spun this company out of the hedge fund only because this technology came along. We could have the Zoom calls with students like you or Skype calls, and we created something called the Great Investments Program. So as well as people learning what we do, they can do it themselves, manage their own portfolios, but we have this hand-holding where I personally one-to-one will do that for them. We'll do that with them. And what I've done is we thought, well, let's take on people to prove this concept, then get venture capital investment into it. And to prove the concept, I take on 10 people at a time. Okay, why limit it to 10? Because I'm doing the mentoring for life. There's no subscription cost, nothing like that. So don't worry, there's none of those charges at all. It's me who does it. To prove this concept works, to prove people's portfolios get that return, okay, and we call it the Great Investment Program because we're looking for great investment. I thought, what should we charge? And don't worry, it's not 90 grand. It's not any of these numbers, all right? Well, what should we charge? Given that we're giving them software free, okay, because our job is to find that free sources of software which tells what are stocks, who's buying what are the analysis, make sure that we've then got it on our spreadsheets for you to access remotely as well. The mentoring, the course material. They go through a dedicated course, which should take them about a month, but it can take less time as well. And we handhold them, go look over their shoulder at their portfolio, make sure they understood the education as well, give them the alerts day to day. And we thought, what could that be worth? And we broke everything down. And we came to some big numbers and we thought, well, we're not going to charge all of this to anybody, obviously. Access to all this research, the portfolio, my portfolio, go over theirs, the daily updates, the free software, the newsletters, and everything else. And we thought, £90,000. Nobody's going to pay that. That's ridiculous. We don't want to do that. How can we make that mass market? How can we make that available to the retail client? So we really reduced it. We thought, you know what we'll do instead is we'll make it available to the retail client, but we'll float the company and make our money that way, make it worth our while that way, not charge you, but charge them. My most successful student who now manages 10 billion at Newton is this lady, Naomi Waistall. She's from university joined me as my assistant, worked for me for 3 years, and then joined Newton. She now manages 10 billion. I'm going to take some credit for that. Billion with a B. Okay. All right. And so I take on 10 at a time. Sean, my friend, I'll answer the question in a second. And that's the thing. Go there if you want to sign up. What I do on my webinars is knock 50% off. There are no ongoing charges. It's one-off in this initial period. We're going to get 200 people go through the program to prove to venture capital investors that it works. Then at a valuation of 50 million, we're going to take the investors on, and a couple of years after that, float it on the stock market. That's the ambition with the company. I want you to join up. That's what I want to do. There is 50% off during the webinar. We've also got installments. So it's not even $9,999. It's actually going to be a lot less than that. And I'll show you that in a second. You can go to either of those links if you want to learn how to do all of this and have me look over it and manage it for you. So give you access to all of this, access to these portfolios as well, the top analysts and what's happening, but also what are we doing? What are we putting capital into? What don't we like? Every single stock searchable across 8,000 as well. Okay, that's the coupon code you use. Somebody's asked my opinion on Apple. I still own it. As I've mentioned on the webinar, I showed you that I still own it. I showed you my portfolio, okay, as it stands today. I've been asked about Apple. Sean, it's my friend Sean. Okay. And that's where it is. That's where you go. By the way, the 7-day no-risk money-back guarantee. Now, the beauty of that is you will get 2 packages. You'll get a signed copy of my book and all the rest of it. We're sourcing the book actually at the moment, so it might be a little bit delayed, that one. But everything else, the USB, you'll get a package with the notebook, headphones, so you can listen to the course material. But there's an amazing course material which goes with all of this, right? And it's phenomenal. We think this is the best educational course in the world. We think also because you've got one-to-one calls with me going over your portfolio, achieving that 20 to 40% return is our goal. There's no guarantees, but that's our goal. Okay, you got access to mine as well. The reason I really love, and we've got some great reviews you can see on the website as well. The reason I really love this, okay, is I'm going to show you this. It's this material. It is all of the software that you get, and there's no ongoing charges, Michelle. There's no ongoing charges at all. Okay, the reason we love this, a couple of you signing up, good, is this. And by the way, as you sign up, let me know. Rob, drop me an email as well. Okay, drop me an email. Complete beginners, you've got all of this as well, right, on this. And what we started doing with all of this and the daily newsletter and the tools and the software is so you're educated. But some people say, I don't want to go through a course. I ain't got time for that. I'm a surgeon. I'm too busy. Well, for those people, the answers are already provided. We rank and rate based on the education, value, growth, income, momentum, Croakey, Altman, Sortino, Alpha, to get that, so you can sack your fund manager, save the money on all of that, and instead get the returns result. Others say, no, I want a PhD in investing, so I want all of this. I don't just want you to do it for me. All right. If you go to alpeshpatel.com/shares, you can. There you go. See, there's a lot of stuff there. You've got me for life. This is updated virtually every single week. Every day you get updates from me on Telegram. You can pay in installments if you wish. There's 5 monthly installments as well, and that works out at under £2,000 per month. Okay, it's normally 20k. You can pay in installments, 5 installments. The coupon is AUG 18. Why? Because today's August the 18th. That's why. And the discount's only for the first 10. Rosamond, it's gone through. Michelle, it's gone through as well. Tino, it's gone through as well. Thank you. Anybody else who signs up, let me know and I will give you a shout out. All right. I do limit the numbers. And the reason I limit the numbers is because it's me who's handling it and I have limited time. I want to prove this concept to the venture capitalists and we're well on the way to proving it. Okay. So if you go to alpeshpatel.com/shares, or shares too, because sometimes when people do this, they have a problem. And if any of you have time difficulty signing up, let me know. I see that you're having a difficulty, Derek. 1 second. I can send you a link. Or if you need to think about it, you want me to hold a place, let me know, and I will send you a link. okay, to reserve your place. Otherwise, once it's gone, it's gone. All right, and that's your pension screwed as well. If you have any problems signing up and you want to just do a wire transfer, you can do that to the company as well. All the details there. If you're outside the EU or the UK and VAT is not applicable, you've got that. You can also pay annually, which obviously doesn't make economic sense, but sometimes people say, no, I'll just do it for 1 year, sort it out and then learn and then go. That's fine. Or there's that, if VAT is included. Those are the bank stuff. Like I said, you can go shares or shares one. Sorry, it's not July 50, it's Aug 18 is the thing. And well, I'll show you that in a second. You don't need to see that yourself. We will go back. There you go. Oops. Go back to that one. What I want to show you is this. If you go to alpeshpatel.com/shares 2, you can pick, like I said, installments, 4 monthly installments, or you can pick 5, up to you, or you can do it in one go, and you will see there the discount is applied with the coupon. Okay, there is a 7-day money back guarantee. In that 7 days, you will have that first call with me. We'll have analyzed your portfolio. You'll have sent me your portfolio. We'll have booked a call. I will analyze your portfolio, go through it all. So if you decide at the end of that, and nobody ever has said that's not, I'm the 7-day, would like to know what the 7-day no risk guarantee means. The 7-day no risk guarantee means this. Within 7 days, at any point, you can ask for your money back and say, Alpesh, it's not for me. Thank you very much. You don't have to give any excuse, any reason, nothing at all. No quibble, money back guarantee. And I should say, when it comes to that, and by the way, we've got customers, we've got half of ours are from America, the other half are from the UK and Europe and Singapore and Australia and Canada and all the rest of it. I'm a public figure. So, you know, it's me on the BBC. I'm a public figure. You do not need to worry about the guarantee. Let's put it that way. We have a 7-day money back guarantee. 7 days is ample time for me to analyze your Ghana, to go through your portfolio, analyze it, give you the access to everything. You'll have gone through everything, looked at everything, and then even if at the end of that you say, no, it's not for me, Alpesh, I've gone through everything, you've gone through my portfolio, Alpesh, you've analyzed it based on what is green, red, and amber, and thank you very much for all that hard work. I'd like my money back. That's fine by us. It's never happened, because when people have that call and they do it, they fall in love with it. So you can see there. Oh, and by the way, if you're in the US, you can, it all converts into dollars anyway for you at the current conversion rate. So don't worry about that, or I can send you a link. Thank you all very much. Trader, thank you very much. Roman, can you kindly ISBN, can you give the name with ISBN of your portfolio's 20 stock? The names I gave you on screen earlier were all the names. I think you mean the epic codes. I can't give the epic codes because I don't have them handy. It's whatever I showed you on screen of the names. You can look up the epic codes yourself. Josephine, my pleasure. Thank you, Josephine. I think you're in Paris, aren't you? I might be getting you mixed up with Marguerite. Okay. Thank you, all of you who have signed up on board. Thank you very much. Michael, there is still a space. You should be all right. If you need me to reserve a space because you need to think about it or anything else, let me know. But once they're gone, they're gone. At the end of this webinar, that's it. They're gone. All right. Because I want to get on with going to my students, and that's it. Okay, as well. Sean, just email me that question, would you? Because I'd like to give you a more detailed answer in terms of just to understand what you're asking about stocks versus exchange traded funds. So I can do that. Any questions I've not answered? Somebody's asked me, what do I think of Bitcoin? It's speculation. I'm not in the habit of speculating, so I don't own Bitcoin. I'm not looking to speculate. Okay, so this is about investment, not about speculation. So Bitcoin is not something I look to do. I want to get that 40%, bang, 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 keep going. Can't see where to add. Oh, Chris, which link are you on? If you go to alpeshpatel.com/shares, it's already embedded in. You won't even need to add it in. Okay, but I'll show you. You won't even need to add it in, because if you go there, whoops, not there. Where are we, Chris? I'm holding a place for you, Chris, so nobody will take it from you whilst we sort this IT problem. It's already there. Have a coupon code. Can you see? It's already there. It's embedded in. it's embedded into the link. Okay, so it's knocked off the discount. It's knocked off 10,000. It's 50% off there. VAT, if you happen to be in the UK or EU, it'll work that out based on your ISP. If you need a VAT invoice, let me know. If you need to claim back VAT, where VAT registered, let me know. We'll send you a VAT invoice, okay, as well. If you want to pay by installments, you've got that. You can also got PayPal, you've got credit card, or Google Pay if you wish. Okay, Visa, American Express, MasterCard, Discover, PayPal, all of those. It's all down there, and you'll be able to see there. If you did, so that's alpeshpatel.com/shares. The reason there's two websites is because usually what happens is a bunch of people sign on, they go to the website somehow thinks there's an error, and so that's why. Here, the place you'd add the on there is you'd click join. Click there, click join there, and it'll say add coupon. There you go. See, August 18, it's already in there. It's in there, and that's why it's discounted for that. All right. So that's why. Or if you joined at the full price, you'd click join, and then you'd click join now. Limited time price. It is limited time because it is 20K. Not where I am, still considering. Okay, that's fine. That's entirely up to you. And you can click add coupon there. Okay, you add it there, and then you click apply. All right. Do you want me to hold the place, or should I let it go? Because there's a couple more people. Chris, just let me know if you want me to hold it for you or not, or if you want me to send you a link so you've got it at the end of this webinar. Whatever works for you, you let me know. Okay. Happy to do that. So that's it. Let me just run through some of these slides again so that you've got them. Okay. In case I missed anything. Once you enter, yeah, that's fine. Chris, just let me know what the question is. That's right. That's correct, Chris. That's what comes up. The URL. That's correct. I created a simpler URL for this because if I use trading-champions.com/p/trading online, which is what the IT engineers came up with, it'd be quite long-winded. That's why I shortened it to alpeshpatel.com/shares because it's easier to remember. Okay, no worries. I'll let it go, Chris. Thank you very much for considering it. Right. So what have we got on that? I want to go through some of the material that I've shown you. So in case you've missed anything on all of this, okay, it's all here, right? Just some of the slides again. Some of you said some of the names. That's just for now. They might be exited tomorrow because it all depends on, that's how we keep everything live and up to date, okay? So don't just think, oh, I'll buy these forever, because that'd be a stupid thing to do. They are for now and for the moment. In actual fact, everything is dependent upon these figures. Those are the things which are the sort of holy grail. And you can see the past 6 month performances as well. So we know we're on the right track because we monitor all of that as well. Harvinder, that's correct as well. Well, I'd say the holy grail is not key. The spreadsheet's not the only thing that's key. I'd say what's actually key is the education material on the course plus access to me. It's me doing the calls as well, Harvinder. I'd say that's key as well. I don't want to say only one thing is key, because if only one thing was key, then that's all you would need. In actual fact, it's a bit like giving somebody a car. Unless they understand how to drive it and use it, they'll mess it up. Okay, so this isn't the only thing that's key. It's also how to use it. It's also key when I show you on our software how to find this, the software that we source for you. How do you find this information that you know how to use it properly? That's key. Or what the hedge fund activity is once you've narrowed down a stock. That's key. Okay, what are the hedge funds doing? How do we narrow it down? That's key. This data that we might have is also key that you understand it. Or what are the big holdings of the big players and names? You got the names there. Feel free to take a picture and research it in your own time. Those are the epic codes, by the way. Somebody asked for epic codes for them. Doesn't mean we're going to buy it, because they might have bought it ages ago and are sitting on a big profit. Doesn't mean it's got much upside to go left. So we still need to put it into our funnel, put it into the Holy Grail spreadsheet as well online. Okay, and the reason we look at Croaky is because we know Goldman Sachs are telling their wealthiest clients that. That's a bit of inside information. We know that they're looking at the top percentile, and that's what generates most of the returns. Okay, so we know we need to look at Altman because we know the biggest banks are telling their clients to look at this. So it gives us that edge. Without that, you're just buying blind. You might as well just pick journalists. And for God's sake, whatever you do not pick stocks based on what journalists tell you, ever. Okay, because think about what their profession is. They're freaking journalists, for God's sake. Okay, we will cross-refer. We don't just say, oh, Deutsche Bank said buy, so we'll just go buy. No, we need to see what percentile do they come into and all of that, and we embed all of that and what the analysts are saying. So all of that is things that you need to be able to do, and we do it for you, actually. But for some people, they want to learn how to do it themselves. They want to know how to do it. But for others, we give them the answer. It's a bit like when your maths teacher gives you the answer to a problem, and other maths teachers just tell you how to do it yourself. I also taught you this strategy. I remember remember this channel you've got access to as well. Okay, I taught you this strategy and how to use that in order to turn a 25% return, well, threefold into 75%. Okay, and have downside mitigation of risk. Listen, thank you, everyone. I think we've pretty much all the seats have gone. The last one, which I was saying for Chris, has gone as well. So I want to thank everybody who's listened. Students, I'm coming to you in a second. Jay, I've held yours. You had difficulty signing on. I'm going to send you an email. Let me do that now. Okay. Michael, Michael, I will send you an email. I will create one more space, a bit like a university. I'll create one more space for you. Okay, so I will send you that email. Let me send that to you now. Thank you very much. I'm glad you're excited. I am as well. I'm glad. Let me send you that email now. It's Michael. No, sorry, Michael. Okay, I'm sending this to you, Elizabeth. Why couldn't you do it earlier? Elizabeth, let me see if anybody drops out, and then I'll send you an email. I'll add you to the list. I'll put you on the waiting list, Elizabeth. Can I do that? Because I don't want to take on more than, it's now going to be 11 with Michael, so I don't want to take on a 12th person, if you don't mind for the moment. But I'll see if, Elizabeth, if there's a space opens up. All right. Thank you all very much. Thank you, everybody, for being on here. I am over the moon, everybody who's come on. Students, I'm going to speak to you in a second. Michael, that email's gone out to you. Jay, I've held that place for you, so you've got a link. You can use that link to buy as well. So I'm delighted you're on board as well, my friend. Thank you very much. And thank you everybody else who's signed up as well. Let's make some returns is our objective. Okay, and I'm going to make sure you got access to all of this information as well, my friends. I'm going to make sure you got access to all of this information as well. All right, so I want to thank everybody who's come on board. Really appreciate it. You've made a very good decision. Let's sort out your pensions, your SIPs, and everything else. Thank you all very much.